So FII selling in the Indian markets, and that too for the entire month of October. I know you might have seen these headlines everywhere in stock market news. So let's go ahead and look more into it. So by how much have they sold? 1.08 lakh crore rupees is what they've sold till 30th October. The number is 1.08 lakh crore. And where is it going? FIIs have sold over 1.08 lakh crore in Indian equities, but invested over 1.5 lakh crore in the Chinese markets. Right? So you see where the title and thumbnail start to make sense, right? The Indian market has seen heavy selling worth 1.04 lakh crore, while the Chinese market alone, along with a lot of other markets, the Chinese market alone has seen buying of foreign investors worth 1.5 lakh crore rupees. So to put that in perspective, while the Indian market corrected 8%, the Chinese market went up by more than 35%, right? 35%, and index, right? And index moved just over the course of 2 weeks. So let's try to understand how big is this number. So we got the point that, okay, a lot of money has flown out of the Indian markets and a lot of money has flown into the Chinese markets. But let us look at how much this sum of money is worth, right? So it is as big as the construction cost of 74 tunnels by the Ministry of Transport and Roads and Highways across India, right? This is a multi-year project, and this is how much they're thinking that they'll be investing to change the face of the country. It is more than India's annual healthcare budget of 90,000 crores, and it is also more than the cost of 9 Burj Khalifas, right? So we have put that there for perspective. Even the Burj Khalifa costed only, I think, 12,000 crores to build, right? So this is how big that sum of money is. So then the question is, why are these FIIs selling for this huge sums of money? But wait, we have to set the agenda for the video first, as we always do. So the agenda of the video is slightly more value giving in nature. First, we'll discuss who is an FII very quickly. Then we'll go into who is a DII very quickly, so that you can understand what is the difference between an FII as well as a DII. Then we'll go into why are they so important for the market, and why are they selling so much. Then we'll go into, is money moving out of India to China, right? So there is no proof for us to say that the exact money that got pulled out of India is going exactly into China, right? That's what we'll be discussing here. Should we be worried? I know that all of you are having decent portfolios when you're a subscriber of MarketFeed, and the question that a lot of people are asking with the recent market fall is that should they be worried? Is this the start of a larger market correction? Then we'll also get into how domestic institutional investors are helping the market. So this is the agenda of the video. So if that's the case, what are you waiting for? This is Ajay Ajith. Welcome to MarketFeed. So first we'll get into who are FIIs and who are DIIs. So the points are very simple here. Foreign institutional investors or FIIs are funds or investors from outside the country, often referring to entities investing in the Indian financial markets. And who are these institutions? They are most likely hedge funds, insurance companies, pension funds, investment banks, and mutual funds. So what do you understand? An investment group which is coming into India from outside the country and putting money into the Indian markets, they are all called as FIIs, foreign institutional investors. So let's quickly look at who are DIIs. DIIs or domestic institutional investors are funds or investors from the same country, right? India's, if any of these institutions, the same examples, mutual fund, insurance companies, pension funds, banks, all of them, if they're from inside India, they're called as domestic institutional investors. When you see the headline that FIIs have been heavily selling in the market, what does that mean? It means that foreign funds, imagine mutual funds sitting in the US, banks sitting in the US, and insurance companies outside the country, all of them pulling away money from India. That is what FII selling means. So the only difference is that both of them are institutions. If they are based out of India, they are called as DIIs, that is domestic. If they are based outside India, they are called as FIIs or foreign institutional investors. What I mean to say by this is also think that they're just random people investing into mutual funds or insurance companies in the US, and these companies investing and withdrawing money as per whatever investment is happening in their country. So at the end of the day, even though they are called as institutional investors, all they care about is making their clients money, who are in fact retailers just like you and me. Then let's get to the elephant in the room. Why are FIIs selling? So the major reasons for FII selling are, first one, FII interest in the Chinese markets. The Chinese markets were undervalued for a very long time, and at the same time, the government brought in a new stimulus package, right? This is all very recent. The government brought in a new stimulus package, which includes raising fresh debt to clear existing debts and government focus to kickstart the economy. So definitely because of the second reason, which is government showing more interest in reviving the economy, them reducing interest rates, them coming up with fresh debt, and coupled with the markets being undervalued, all of this together is a perfect formula for the money to flow into China. Right? And that is exactly what is happening right now. Then keeping the Chinese reason aside, there is also the war uncertainty, because of which we saw the market being very volatile, Iran versus Israel war. But if you're getting into the three regular reasons, which we have already discussed in the previous video, they are FII selling has oddly coincided with the SEBI circular on F&O, mediocre earnings of Indian companies reducing valuation targets, as well as retailer panic in India. So all of these combined are causing the market crash and FII pulling out money from the Indian market right now. Then let's take the question back. Should we be worried? So let's look into that, and the simple answer is no. But why? Let's start with the first major reason, which is 1 lakh crore is not a very big number in the financial markets. So we started with 9 Burj Khalifa, 72 tunnels, but then it's not a big deal. Again, it's a big deal in the discussion of many other things. But in the case of the financial markets and financial transactions across countries, 1 lakh crore is not a big number. So FIIs have 64 lakh crore rupees as investment in Indian equity markets. And the total market cap of all the publicly listed companies in India, it is $5 trillion, or somewhere between 400 to 460 lakh crore rupees. So 1 lakh crore, which is the amount which they have sold in the month of October, that is only 1.5% of their total investment. So let's say you had invested 100 rupees into the market, or let's say 1 lakh rupees into the market. If you booked 1% profit on that portfolio, will you be worried, or is it even a big deal for you? Again, whatever you had invested, you might only be pulling out the profit also. You would not even care for a 1% part of your portfolio. So that is why I'm saying it is not such a big number as you think. So let's look into the last 10 years data to understand more about the current situation, right? And if you should be worried. So last 10 years, FII investments are continuously decreasing. Again, this is another headline that you're seeing everywhere. FII investment is at a 10-year low, 5-year low, whatever. But at the same time, DII investments are increasing. So do you remember who is FII versus DII? We had explained it very beautifully. So yes, it is true. FII investment in India in 2014, it was 23.3% of the total market cap. In 2024, it has reduced to just 16.43%. DIS, on the other side, it has gone up in the last 10 years from 8.5% to 16.05%. So you can see that more domestic institutions are supporting the market, and right now FII versus DIA participation in the market is almost equal. So all these news headlines and triggers should not be a worry for you if you still believe in India's growth story. So FIIs will still return if they see that the Indian market is lucrative. How can they be lucrative? Either in terms of valuation, that is, the market is cheap, or in terms of growth. Right? That is something that a lot of people are forgetting. India is still one of the largest or fastest growing economies in the world, right? So two things can happen. Yes, now the valuations are stretched. They're pulling out their money. They're investing into somewhere else looking at value. But across history, real gems are what have survived. So make sure you have that in mind. So if that is the case, I would say the answer is you should not be worried for all of these reasons. Let's conclude by also looking into these 2 points, which is, yes, Indian markets were overstretched and overvalued. That is true. But even after the recent correction, Nifty has returned 12% returns for the year. right? Even with the current fall, Nifty has moved up 12% from January 1st of 2024 to today. And that I feel is what you should be looking as an investor. You should not be caring about these very short-term volatilities. And yes, DIS stake increasing is a double-edged sword. So on one side, we know that DIS supporting the market, it will prevent us from a lot of foreign threats. In the world that we are living in today, military or physical threats are not the only problems for a country. There are financial threats like we saw during the Russia-Ukraine war, a lot of Russian assets getting frozen and all of that. Attacks and threats on the stock markets and currencies across the world, trying to destabilize their financial system. So DIS coming up and having more power is good for the Indian market. But at the same time, most of these DIS are also blindly investing because of certain rules and restrictions that they have. One, whatever SIP money that they're getting from all of us retailers, from me and you telling that, okay, invest, they are liable to invest. Let's take the case of mutual funds. They can't hold more than 5% in cash. Right? So even if they want to hold on to cash and wait out or try not to invest or wait for good valuations, they cannot for legal reasons. So that is a threat right there. So if you believe in the Indian markets for the long term, the financial markets are still a good place for you to come and invest your money and try to make returns out of it. Yes, there can be downtrends. It can be over the course of 1 month, a quarter, or even a year. If you have invested more than what you're capable of, you will be trapped in these short-term market cycles. But I would say as an investor, you should be investing for the very, very long term. At least 3 to 5 years is what your horizon or your investment period should be for your equity holdings. With that in mind, let's wrap up today. So if you have not watched the previous video on 5 Nifty 50 stocks available at good levels, go check it out. I'll also try to link the video here on volume profile indicator, which I feel is really interesting for traders. So if you're a trader, go check out that video too. This is Ajay Ajith signing off. See you all again next week with something very special. See you. Bye bye.